Hello, I'm Peter Towers, Managing Director of ESS BIZTOOLS. Welcome to this overview of virtual CFO service delivery. It's a very important subject. So I'm going to share my screen so that you can follow the material with me. And hopefully you will be able to get a better understanding of what this whole process is about. So what is the vertical or fractional CFO services? I noticed the other day this terminology of fractional CFO services. It's very similar to virtual CFO services. It's just that people are offering their services on a part-time basis. So it's basically the same as what I envisage that accountants in public practice in Australia are going to be able to offer to your SME clients to help them with this journey of creating great businesses. Now, every business has cash in and cash out. That's our basic philosophy in our training, isn't it? What you can do is, if your firm is offering a virtual CFO service, of course, is look at the management of those cash funds, whether they're created by direct transfers from bank accounts, as we all do these days, or credit card transactions, or coming from a product like on the internet. It doesn't matter. It all has to be accounted for and recorded. SME needs financial assistance beyond taxation. Now, I think this is a very important issue. Large businesses employ accountants to manage their cash flow. SMEs also obviously have cash flow. I think it's important that we recognize that as a profession, we have probably ignored the real services that our SME clients should be receiving, or at the very least, we should be offering a firm proposal to them that we can deliver these services to them, not just taxation. Taxation services doesn't help your client to run a better business, doesn't help them improve their bottom line profitability, doesn't help them improve the overall value of their business. So what's involved? I think there's a need for virtually every business to be receiving a weekly performance report, which would include a profitability analysis. I was the CFO in a listed public company for 12 years of my career. And we were in the meat industry. We had hundreds of business outlets, retail, butcher shops, meatworks, boning rooms, and a whole stack of other activities in 3 states. For each one of that nearly 500 business units, a weekly performance report was prepared. And that included a profitability report. And the CEO expected those weekly performance reports to be within 2% of what the monthly financial account showed. So we had to have a mixture of actual information. Obviously, we knew the income, but we had to estimate some of the expenses, and you can get very accurate when you do that. Isn't that the sort of information that your client should be receiving? So that's one of the real big wins. You set up a system whereby your client knows how they're going week by week. There's also monthly management accounts, very important. I emphasize the word management. Not everything lumped together into the profit and loss account the way you do it for the taxation return, but broken down into every business unit so that your client can get a real feel. And whoever's in charge of a particular operation gets their profit and loss account, because that's what they're responsible for. Comparison to budget for each business unit. And I've probably started this presentation a couple of slides further in than what I should have, because I'm assuming and we're going to come to it, we're going to have a budget for every business activity. And then therefore it's necessary to compare what the result was for that month to what the budget said, and to then analyze the budget variations. Key performance indicators are a huge part of running a business. Yet my observation is most accountants who are concentrating on the preparation of income tax returns barely refer to key performance indicators, perhaps other than gross profit percentage and sales growth. But there's a lot more goes on in a business. It can be all sorts of things: wastage, spoilage, shrinkage percentages, weight losses in the meat industry are very important. Fat content is very important in the meat industry, and every industry's got its own peculiarities. And then it's the analysis of those KPIs and the recording of this week to last week to the averages. That's the sort of accounting work that goes on in business and industry. And if you're going to be supplying these types of services to your SME clients, you need to make sure you are able to do that. And our strong recommendation is that this package of services for chief financial officers incorporates a business review meeting each month, so that you can sit down with the team and help them analyze exactly what happened, what went wrong, what went right, what went very good. Taxation is not the prime reason that big business employs accountants. They employ a lot of accountants to do the things that I've just analyzed. SMEs also have a significant requirement for accountants to assist in areas other than taxation, which I've just summarized. And there's more, which I'm going to come to now. But please think about it. Please think about how you can help your client to add value to their business. Just as you could if you were working for BHP or Woolworths or Coles or Bunnings. Those big businesses employ a lot of accountants, and they're not sitting there doing taxation. So let's go back to the beginning of this. I think it's very important that accountants who want to undertake this role embrace the concept of having a clear understanding of the business of business. What do I mean by that? Business of business. If it's a manufacturing business, where does the chain start? Perhaps it starts with raw material supply. Where are they coming from? What's the supply chain like? What key performance indicators can be developed out of supply? It could be delays in delivering, could be an important information that management would like to know. So sit down and talk to, first of all, the person in charge of ensuring that supplies are delivered. What does that person need to know? And then discuss it with more senior leadership team or management people to ascertain what they would like to know. It might be the quality of the supplies that have been received. I think it would be obviously whether the receipt of goods has been in accordance with the agreement of how often supply is going to be delivered, because in the last 2 years, we've all learnt a lot about supply delivery problems, haven't we? And senior management is very conscious of this. The businesses can grind to a halt if that service delivery is not working correctly. But what else goes into understanding the business? What's the flows? Do the various people who receive reports understand them? Do they know what's meant by this information on a sheet of figures? Some of it might be accounting jargon. They got no idea. I'd suggest you sit down and talk to them. I did that many years ago at a major meatworks that my company owned, the company I work for owned, and sat down with the foreman in their smoko room and said, how you going with this report? And they said, what report? I said, these key performance indicators we give you every day. And the answer was, oh, we don't look at that. We don't understand that. So it goes straight over there into the rubbish bin. And I thought, gee, that's not what we think happens to them. We think we're producing this information so that they can use it in undertaking their work. So I said, I'm going to come back at lunchtime when you're having your sandwiches, and how about we have a bit of a discussion? So we had a whiteboard moved into their lunchroom and we went through it. And basically we changed quite a number of the titles and terminology used within the report. I got them to sign off on it. That's what they wanted. That's what they wanted to call it. Instead of an accountant or an office manager deciding what it was going to be called, we let them call it. And we got far more reaction because they then had some ownership of that set of figures when they got it each day. In fact, one of our office managers at a meatworks complained to me. He said they're now demanding it. They want it by 9:30, which was one of their key smoko breaks. They want to see yesterday's percentages. And that was great, I thought. I wasn't worried about the office manager complaining. He just had to get his act together a bit quicker. So hopefully that will give you some indication. Let's go back to the review of the product service chain from the beginning. I've probably referred to that. That's part of the business. Clients need a business plan. And if we're going to be offering chief financial officer services, that's very important. But get their input. Don't you just sit down and write it, please. Get the leadership team together. In some businesses, I'd be encouraging there to at least be one session, maybe 1 or 2 hours with everyone there, the whole team. Let them have their input. What could we do to make customers happy? How can we get feedback from customers? What changes would you make if you were sitting over there in the CEO's office? You get some interesting replies to that question. But you've got to make sure it's delivered in a non-threatening manner to the employees. Facilitate the preparation of budget and cash flow forecasts for 5 years. I think that's very important. That the business has a vision, that we can analyze where it is likely to go. What is the end result of the decisions you're making today? Now, 5 years' time is a common projection period. You might make it 2 or 3. That's up to you and your client. But take it at least 2 years hence so that they can see what the outcome's going to be of the decisions. They can see what their business is going to look like. I think you could also do a business valuation. So if your balance sheet looks like that in 5 years' time or even 2 years' time, this is what I think the business will then be worth. Because if there are implemented improvements and in both bottom line and in the processes and in the systems manuals and in their corporate governance, you should be able to use a higher multiplier of their after-tax profit as part of the calculation of the worth of the business. And that might give them a real incentive to work towards, because you're showing them what their business could be worth. Facilitate the preparation of the projected balance sheets for 5 years' time as part of that process. Let's keep on going. Let's look at some of the financing arrangements that you could be looking at. Loan applications. Yeah, in lots of cases, you probably do them already. But raising capital has become a far more important role that you could perform, because the government, the federal government, the previous government, I probably should define it as, brought in some very interesting changes to the legislation. We now have crowdsourced funding equity raising, and we have early stage innovation companies, both of which can raise capital for SMEs. There are some restrictions. There are processes, of course, but if you're offering a virtual CFO service, I suggest you need to be very familiar with these so you can help your clients. Or we can go back to Section 708 of the Corporations Act, which has been there for nearly 40 years to assist us to raise capital for clients. Sure, there's a $2 million limit if you're raising money off retail investors, and you can only invest from 20 of them. And if you did it for a couple of years from 20 people, you're very quickly going to be exceeding the 50 shareholder limit for a private company. So you need to have all that in your mind, but you can raise capital. Or you might want to look at venture capital, or even initial public offers if your client's bigger and is keen to grow and they've got a fair bit of money set aside, because an IPO costs a lot of money, a lot more money than what crowdsourced funding or early stage innovation companies will be. I think a lot of your companies could look at, first of all, going down the crowdsourced funding path where they can raise $5 million, go back and raise another 5 million next year and 5 million the year after if they want to, and if the market supports them. Might be a lot cheaper than going through the initial public offer and then being bound by all of the stock exchange disclosure rules, and they are quite onerous. As I said earlier, I was a company secretary and of a listed public company, and there's been a lot of changes since I had that role, and they've got this concept now of continuous disclosure. So people need to be aware of that. They're in the public eye. Let's look at the cost advantage. It's a lot cheaper for your client to engage your services than to employ a full-time CFO, unless they've got enough work and enough money they can pay a person to work on a full-time basis as a CFO. But many of them won't want to do that. There won't be enough work for a CFO, and they don't want to outlay the sum of money involved, which will be over $200,000 plus superannuation, and obviously holidays come into it and everything else. So this is an opportunity for you to be able to create a niche in the marketplace, to get the reputation that your firm can deliver virtual CFO services. But it's like everything. When you bring on new people to work in your taxation services, you have to make sure they have been trained, they read files, they watch videos. The same thing applies to the delivery of these services, and there's probably more variables than what the average taxation regime is for an SME client. So it's important that there's adequate preparation to take on these types of appointments. And the key thing, I think, is getting an understanding of the business. How's it work? That business of business knowledge is very important. And try to familiarize yourself with the industry. Where is this industry? Where's it going? And you must make sure that your accounting team understands the important role that the firm is offering to the client as a virtual CFO. But when I said the firm, that it's going out under your firm's name, but there's only a small group of people within your immediate team. There might be only one or two, maybe three, who are in direct contact with the client. But this service is basically being offered 52 weeks of the year. The client's got a problem, they ring, and there will be daily and or bi-monthly activities. And I think it's very important to make sure that there is at least monthly activities. There is a monthly business review meeting so that you're in contact with your client. Your team members will be in contact with various personnel working for your client. And understand that all this is being delivered under this overall banner of Virtual Chief Financial Officer. If you've got any questions on how we envisage that you can deliver the Virtual Chief Financial Officer Services activity to your clients, please send me an email, peter@essbiztools.com.au, or make a phone call to me, 1-800-232-088, and I will get back to you. Thank you very much for your support of ESS BizTools and ESS BizGrants. If you have any questions on any of the services that we provide, please don't hesitate to contact us. This was the first in a series. We have a follow-up webinar in September, and we will be confirming the date of that next presentation. If you want to attend live, you're most welcome to do so. If not, I hope you've enjoyed watching this video in your own time. And if you've got any questions, please get back to us. Stay safe. Have a great day. Goodbye.